let's talk about how to prepare a budgeted income statement. Basically, it's very much like preparing an actual income statement. The only difference is it's based on budgeted amounts, not actual amounts. So, like any income statement, we start with sales revenue. We have this information from the sales budget. So all we have to do is add up sales revenue from April, from May, and from June to get the total budgeted sales revenue for the period. Next, we need cost of goods sold. If this happened to be a just-in-time firm, that would be very easy because just-in-time firms always sell exactly what they make. This firm has an inventory policy. That means that we need to compute cost of goods sold in very much the same way that we did when we were making a schedule of cost of goods manufactured and sold in an earlier chapter. So, let's see what goes into cost of goods sold. First, we need to account for direct materials. So we take our materials inventory on April 1st, and we know that was expected to be 20,000 pounds at $1.50 per pound. Then we need to consider our purchases during April and May and June. Altogether, our direct materials beginning balance plus all of our purchases during the period equals the dollar value of all of the materials that we could use. But at the end of June, we had budgeted that we wanted to have 50,000 pounds left over going into July. 50,000 pounds times $1.50 represents the portion of all of our materials that we expect not to use. The dollar value of all of our materials minus the dollar value of the materials that we expect not to use gives us our best estimate of the dollar value of all materials that will be used in production during the period. Next, we need to consider labor. We can add up the labor for April, May, and June. Remember, labor can't be inventoried. It can't be saved for later. Finally, we can add factory overhead. Altogether, the materials plus the labor plus the overhead gives us our total manufacturing costs. Next, we need to determine how many units we got out of all of these costs. We can add the number of units produced in April, in May, and in June to get the total number of units. We can divide 41,800 units into our total manufacturing cost to get the average cost per unit, $27.36. Now we can use that information to determine the value of our inventories. We know that we already had finished goods available on April 1st, specifically 6,000 units. Assuming that prices haven't changed between last period and this period, we can assign those units $27.36 of average cost. If costs have gone up or down between March and April, someone would have to tell us. So if we take all of the manufacturing costs that we used during these 3 months and add to it the dollar value of the finished goods that were already available in April, that gives us the total cost of goods available for sale. However, we also know that we expect to have 10,800 units in finished goods at the end of June going into July. At $27.36 per unit, we can determine the dollar value of that finished goods inventory. Those units we don't expect to sell, so we can subtract that dollar amount from the goods that are available for sale to get cost of the goods that we expect to sell. Now we can bring that information back onto our budgeted income statement. Now we can compute gross profit as the difference between our sales revenue and cost of goods sold. Next, we need to compute our operating expenses. Our selling expenses we can find by looking at our selling and administrative budget, and we can add the amount for April, May, and June. Our administrative expenses we know are the same every month because they're fixed. So $20,000 a month times 3 months, we can figure that out. Then we can also consider bad debt. That's not a cash expense, but it is an expense. We estimated it at 3% of sales. Finally, if we borrow the $90,000 to make our cash policy, then we need to consider the interest on that $90,000, which is 9% per year for April, May, and June, 3/12 of a year. Add that up, and that gives us our total budgeted operating expenses. Subtract that from our gross profit, and that gives us our income before income tax. Then, assuming we live in, say, a 40% tax world, we can subtract out our income taxes to get our bottom line net income for this 3-month period. Now we can look at that number very carefully and think to ourselves, does this support management's agenda? In other words, if everything occurs exactly the way that we have budgeted, are we going to be proud or embarrassed to show the actual income statement to the boss? And if the answer is proud, then we're done. Live the period. Hope everything comes out the way we planned it. But if the answer is embarrassed, what can we do about it now? What can we do at this point in time before that period starts to increase revenues, to decrease costs, to change our plans for borrowing or repaying or investing in new capital assets? If this is not the future we want to live in, what can we do to change it? And that is the tremendous benefit of budgeting. There are several other types of budgets. We've been looking at traditional budgets, but there are some other budgets that you need to be familiar with. Traditional budgets, or they're sometimes called static budgets, are prepared at the expected level of activity for the coming period. And that's exactly what we did in our budgets. We had an expectation of how many units we would sell each period, and all of our other budget numbers were related to those expected sales. A different way to look at budgeting is to use a flexible budget. A flexible budget can be created for lots of different levels of activity. It's a kind of sensitivity or what if analysis. What if we were a little busier? What if we were a little less busy? And we'll take a look at flexible budgeting when we do our work in the next chapter. Another possibility is to do activity-based budgeting. In this case, we use our expected level of output, but we look at the activities that are necessary in order for that level of output to be possible. So how do we know if we're doing a good job in our budgeting? Number one, it should give people feedback on their performance. In other words, the budget sets a benchmark, and then we can compare actual performance to that benchmark to determine whether people are doing what we expect and to determine whether our budgeting numbers are reasonable. In addition, budgeting should involve incentives. Those incentives could be monetary, but they could also be non-monetary, and they relate to meeting various budgetary goals. Number three, firms should definitely have some form of participative budgeting. We talked about this at the beginning of the chapter. That is, people who are responsible for achieving budgetary goals should have input into what the benchmarks are going to be. What is possible? What do they need in order to do their job? Budgeting should also be realistic. There is no point in budgeting costs that cannot be achieved, or sales goals that cannot be met, or manufacturing goals that are impossible. All it does is undermine people's optimism, confidence, and willingness to work hard. If you know you can't meet budgetary standards, what's the point of even trying? Another characteristic of good budgeting is the controllability of costs. For example, the production manager may have fairly good control over how long it takes for workers to do certain tasks or how much material is consumed in various tasks, but the production manager does not have control over the wage rates for workers or the cost for the materials. The wage rates for workers belong to the Human Resources Department, and the cost for materials belongs to the Purchasing Department. Finally, you should always assess people's performance from multiple viewpoints. If you tell people that the only thing that you care about is saving costs, saving costs, saving costs, that's what you will get. But that's not really what you want. Remember, we are what we are rewarded to be.